I'm going to have software that's going to have candlestick recognition, and it's going to allow you to filter through any markets, Forex, stocks, you name it. You could have your whole portfolio, Russell 3000, all the crosses, all the pairs, pick out all of them that have bearish engulfing patterns and or a hammer and are above a 200-day moving average and have the RSI above below 20%. And it'll give you all the symbols for that. You could have a chart on the screen, highlight all the candlestick signals. It'll highlight all the candlestick signals. It'll also do real-time intraday. Pick out all the Forex markets, all the equity markets. I think it limits to 200 real-time that are currently building a hammer. So the reason I mention that is because I had to think in concrete terms, how much is too long an upper shadow? I never had to think about that before. Yes?
On that hammer, how often or what's the probability that that's a good signal that the market's going to go?
Okay, the question is how likely is it's a good signal? This brings us back to increasing the probabilities of a trade. Okay. If this hammer confirms a support area, the probability is higher. If, and we're going to look at this later, this is very common. I most often see the lower shadow of the hammer tested. It's rare to have the market sell off, have a hammer, and just rally without coming back into the lower shadow. So one strategy to think about is wait until it gets into the lower shadow, anywhere from the half part, and this is not 100%, but this is from my experience, anywhere from the half to the bottom of the lower shadow. And this is, see this bit of an upper shadow? That's fine. So I've found that the lower shadow is very often retested. Mm-hmm. Okay, the question is, he said, how do you pronounce that? Suresh sees a hammer, and the next time it closes under it, right? Next day, it just keeps on going down. Great question, and this is one of the ways people misuse candles. Just because you buy in a hammer doesn't mean the next day the market's going to rally. We're going to look at a real-world example. We're going to look at an example of that. Whenever you initiate a trade, you can write it down now or later, but it's probably one of the most important things I'll be talking about later as far as money management is concerned. We always have to think about the risk-reward. Before you pull the trigger on a hammer, you set your stop-out level. What's the stop-out level? That's what this chart is about. The low of the hammer should be support. So you defined your risk. Your profit potential is going to be subjective. Okay, I usually use higher the most recent high. So for example, on this hammer here, great hammer, I don't think I would do that trade. My first resistance area, yours might be different, but I'm looking at short-term resistance here. Correct? If you're buying here and your target is here, now very important, use the candle signals to define your risk. The low of the hammer should be support. One of the questions we had, and it gets back to Suresh's question, during the survey, specifically they say, hey, how come sometimes a hammer doesn't work? It's the real world, right? You set your stop. If you have your stop here, is this a good risk reward? Terrible. You don't do the trade. You step away from the trade. If it happens to be a good risk reward, in other words, if your target is up here and the market gets under here, you're out. You're wrong. The point is you have to be willing to risk to the low of the hammer as your stop-out level. It doesn't mean the market's going to rally the next day after the hammer. It could, in fact, we can go back. See? This hammer, we went back a slide. Did the market rally the next day? No, but if you're using low of the hammer support, should you still be in? Yes. Even if it closed down more into the lower shadow, using the concept of the low of the hammer support, would you still be in? Yes. So it's okay for the market to sell off. Nothing wrong with that. The time I would get nervous is if the market closes under the hammer. Okay. This is something that people forget about, that yes, you have a hammer, and the next day the market could sell off. A hammer doesn't mean the next day the market's going to rally. The hammer means it should be a support area. Okay, we saw this before with these lower shadows down here. And normally, just because the market has a series of lower shadows, I wouldn't recommend buying it unless it's, you know, a solid support area there. But the blue arrow points to a hammer. That's one of the reasons the market stabilized. Question? Okay, we're going. Mm-hmm. Mm-hmm. Mm-hmm.
So wouldn't you already be looking for a reversal at this point?
Yeah, that's a good point. What's happening is, and you can see, let's move this. Okay, so he's saying we have a doji and a spinning top here. Aren't we getting a hint the bears are losing some steam? Yes, but it's still making lower closes. I would be nervous. I would want to see, maybe I'd pull back a little bit on a short position, but didn't we have the same thing over here? Right, okay. So our short-term trend would be down neutral. Our short-term trend here would be down neutral, maybe scaling back a little bit on the short position. Now, boom, that's the confirmation, right? That's the bullish confirmation. Right, now you have a support level, exactly, as he was saying. That's the bullish confirmation to me. So these are tentative clues. These are tentative clues. This is the confirmation. If the market's solid, what should hold as support? The hammer. Question?
Go back to slide number 28,
Okay.
and let's say you take a long position on the hammer.
Mm-hmm.
And then if you go like 5 and 6 candlesticks forward to the right,
Mm-hmm.
the spinning tops on long black candle.
Mm-hmm. Here?
Is it a close new position on that?
No, I move up stops here. I just move up stops. We'll look at stops later, but usually what will happen if the market starts moving and you move and moving in a direction, I would immediately move up the stops. This is what the professional traders do that I work with. They'll move up their stops immediately to break even. What I mean by break even, the amount you were willing to risk, I'd move my stop up to that level. So if you were risking 20 or 30 pips, I'd then move my stop to 20 or 30 pips right away. This is a great trade because on this hammer here, although I would view this, and once again on our newsletter, daily newsletter, we'll have different levels of resistance, R1, R2. I would have this as R1 and R2. And I would have a check mark at R2. In other words, it's a more important resistance. So this, if you're buying on this hammer, you might have a little bit of resistance here, but this to me is minor. If you're buying on this hammer, I would have a little longer term target up there. It's a really good risk reward. But getting back to your great question, what if the market is starting to have problems here? Then you may want to think about taking some profits. Nothing wrong with that, or moving up stops. And we're going to look at a technique called adapting to the market a little later. So let me move on. The opposite of a hammer is a shooting star. And this is true for most of the candlestick signals. For every bullish candlestick signal, there's usually a bearish counterpart. And the shooting star, long upper shadow, small real body at the bottom end of the trading range. It's okay to have a little bit of a lower shadow, kind of an upside-down hammer. And the real body can be black or white. And as the Japanese would say, it's signaling trouble overhead. So here we had a shooting star that came after a rally. And here we have a hammer. And you can see with the hammer how it held as a support area. Not surprisingly, the shooting star should be a resistance. If the market closes above it, if you're a momentum player, you're looking to buy on strength, you buy on a close above a shooting star. Flip side, if the market breaks under the support of the hammer, you're a momentum player, you're looking to go short, that's the time to do it. Okay, the shooting star, as shown here, should be a resistance area. So if there's a shooting star, and by the time the shooting star is formed, let's say it has an extremely long upper shadow, by the time it's formed, if you have a bad risk reward, you don't do the trade.